FTX says it's recovered enough assets to pay most creditors back in full. That's coming up on Business Matters. And good afternoon. Thank you very much for being here with me. I'm your host, Don Ma. Okay, we're starting off with markets as usual. The Dow here today closed higher, now stretching its winning streak to 6 straight. Meanwhile, on the other Wall Street benchmarks, they fell a bit. S&P 500 ended essentially flat here after 4 sessions of gains previously. And the NASDAQ Composite as well today slipped to a second consecutive decline. So not much here to move the indexes in terms of news. That's outside of course, reports from individual companies. We're just waiting for the next catalyst to jumpstart the direction in the market. We're probably going to get that next week. And FTX has recovered enough assets to pay most of its creditors back in full. The failed crypto exchange said this on Tuesday as it unveiled a proposed reorganization plan. Let's go to NTD's Sean Marshall now for more.
Crypto exchange FTX will have between $14.5 billion and $16.3 billion to pay its creditors and customers, according to a new filing. Available to explain what that means is former head of FTX Europe.
A reorganization plan in a Chapter 11 bankruptcy, like the one for FTX, is basically a plan that outlines how the debtor wants to pay back his debt. So how are all the creditors getting paid? The ultimate goal is usually to remain in business, getting out in a restructured way of the bankruptcy. But the most important aspect here for the FTX creditors is really how do they get back their money and when do they get back their money and at what rate.
FTX said the $14.5 billion to $16.3 billion figure is based on monetizing assets, most of which were investments owned by Alameda Research, the crypto fund controlled by Sam Bankman-Fried, and FTX Ventures businesses. FTX expects that the majority of its creditors will receive approximately 118% of the amount of their claims within 2 months. That's if the plan is approved by the court, though FTX might not be able to continue business in the future.
But I've not seen any indication that this is actually planned. So right now, I think the main objective of this restructuring plan is just to distribute the assets that were collected and finish basically this company in an orderly way. So in my personal opinion, I do not think that FTX will be restarted.
FTX was once among the world's top crypto exchanges. Earlier this year, its founder Sam Bankman-Fried was sentenced to 25 years in jail for stealing $8 billion from customers. It shook the sector in November 2022 by filing for bankruptcy, leaving an estimated 9 million customers and investors facing billions of dollars in losses. Sean Marshall, NTD News.
Thanks for that report, Sean. But besides FTX today, we have a couple of earnings to go through. Reddit floored investors with its first earnings report since its market debut. Shares soared over strong revenue growth and improved profitability here. So this is showing that Reddit's push to grow its advertising business and content licensing deals with AI-focused companies are paying off. The site's more than 100,000 discussion forums are filled with user-generated content that is very attractive, in fact, to partner companies looking to train AI models. Now, according to LSEG data, several analysts have raised their price target on Reddit stock to a median view of $55. And with demand up for ride-hailing services, Lyft is projecting higher than expected gross bookings and core profits for this quarter. Lyft has been luring customers in with shortened wait times for pre-scheduled trips while trimming costs to boost profitability. And also according to LSEG data, Lyft now estimates gross bookings to be around $4 million. Gross booking represents the total value of transactions on its platform. Now, as for adjusted earnings before interest, taxes, depreciation, and amortization, Lyft estimates at least $95 million. And on the other hand, Uber has also reported earnings today, but has posted a surprising first quarter loss and a gross bookings forecast that is sort of below Wall Street expectations here. And as a result of that, Uber's stock price slid down. It was the steepest single-day decline since October 2022. Uber reported a new loss of more than $650 million in the first quarter. Analysts were expecting a net profit. So Uber also missed expectations for quarterly gross bookings. Uber said it expects second quarter gross bookings to be at least $38 billion, which is also below estimates. And a proxy fight underway at one of America's major freight railroads. It could even reshape the future of rail safety. Control of Norfolk Southern is up for grabs at its annual meeting. The current management has been credited with improving safety practices since a massive derailment in Ohio last year. Activist investor Ancora Holdings wants to bring in her own directors and executives and improve profitability. Unions, though, on the other hand, are split on which management each supports. Investment giant Blackstone's $59 billion real estate fund has baffled Wall Street. Blackstone Real Estate Income Trust, also known as BREIT, has boasted a 10% annual return since its debut in 2017, while many rivals has fallen in value over high interest rates and a declining property market. According to DealBook, criticism is growing over the fund's performance, in part because of the way Blackstone appraises the value of its assets. It and major firms use a third-party appraiser, but for Blackstone, it has the final say on the appraised value of its assets. Blackstone told DealBook its process requires property valuations by a third party, which it has never overridden. And earlier, I spoke to a real estate expert about this, Robert Helms. He's the host of the show called The Real Estate Guys. Take a look. Robert, thank you so much for your time today this afternoon. So Blackstone, it's a real estate income trust, getting 10%, 10.5 actually, annualized returns since its inception in 2017. Some skeptics out there, I mean, let's touch both sides here. What do you think? Is Blackstone just really good at its job?
Well, they're the biggest commercial real estate holder there is. I would say they probably are very good at elements of their job. What this is, the trust we're talking about, is a non-traded real estate investment trust. It's a big bunch of diverse real estate, and the whole premise of this particular trust was to give folks an option to get exposure to real estate and let Blackstone do all the work.
So some are questioning how it is able to outperform all its rivals. What do you think? Is there any merit to the skeptics here?
So there are always skeptics when anyone's doing well. So I will say that their performance, as you mentioned, over 10% annualized since their inception. Now, part of that is the timing. Back in 2017, when this REIT began, we were in a very different place. Interest rates were low and real estate was doing well. And so it's quite possible that many of those assets performed well from both a cash flow and an appreciation standpoint throughout 2018, 2019, even parts of 2020. But the other part is a 10 or 10.5% average annualized return is just that. It's just the average over time. It could be that there were a couple of years where things were more like 18 or 19%. And there's some times like today when the returns aren't as good. And this is part of the reason that investors consider a fund of any kind, because you're getting the diversity across market types, and in this case, different product types within real estate.
Yeah, exactly. I mean, that is very true here. Also, I want to touch on what some are questioning when it comes to Blackstone's appraisal process. A bit different than the others. Any reason to doubt this process here?
Well, I think the reason people are concerned is it's kind of a black box. If I'm a publicly traded REIT, then I have a process for ongoing valuation. And every day, if it's publicly traded, the market decides what the value is, right, based on buyers and sellers. And so they're going to want to know, what are the cash flows? What are the appraised values? What's happening trend-wise in the sectors? And all that's important information. In this case, because it's non-traded, these folks are not obligated, apparently. I have not read the entire prospectus, but my understanding is they're not obligated to explain their methodology. And so the members, the shareholders, the folks that are investing, don't really have the formula that they use to come up with the valuation of the assets. But overall, their claim, Blackstone's claim is, hey, we're pretty good at picking markets and property types. But on the skeptic side, there's two major concerns. The first you hit on, and that's valuation. If the valuation isn't true, isn't real, then how can we tell? Because we're not given the information. And I would say that is a valid concern. It comes down to trust more than anything else. But the second concern that folks have had is, in this fund, apparently, you can ask for a redemption. You can cash out of the fund with proper notice. And when the valuation was on its way down a little bit, there were people trying to get out, and they weren't able to all get out quickly. So apparently, the REIT said, hey, there's a provision that says if you ask for redemption, we have some time and it's going to take us some time. Now, I get that because real estate, as we talked about, is not very liquid. So I think the lesson is, as an investor, you always want to match your personal investment philosophy and strategy, what you're trying to accomplish, with what the piece of real estate, or in this case, a fund made up of lots of real estate, is designed to do.
Well, all right, a great note to end this interview on. Thank you very much, Robert. Great insight today.
Thanks, Don. Thanks for having me.
As well, President Joe Biden is in Wisconsin touting a new $3 billion Microsoft data center today. According to the White House, the Microsoft facility will result in 2,300 union construction jobs and about 2,000 permanent jobs over time. And Microsoft saying that it will use the center to train about 100,000 workers across the state on generative AI by 2030. And Taiwanese manufacturer Foxconn ended up scrapping its $10 billion factory there previously. Coming up after the break, the U.S. has revoked licenses for Intel and Qualcomm to ship chips to sanctioned Huawei. Will this move hurt the Chinese telecom giant? We have expert analysis you won't find anywhere else. And as well, after the break, $1 billion in unclaimed tax refunds from 2020, and the deadline is coming up fast. That and more after the break. Stay tuned. All right, thank you for staying with us here. I have some quick headlines to go through with you. The 2024 National Hockey League draft will take place at the Sphere in Las Vegas. It's the first sporting event at the Sphere and first live event televised from the venue, which opened to the public in September. The draft takes on June 28th and June 29th. The San Jose Sharks got the #1 overall pick. And Morgan Stanley is moving back its rate cut timeline estimate. The brokerage says that it doesn't expect the Fed to cut rates until September. Its earlier forecast was in June. Analysts are saying at the bank that it's too early to say if inflation is re-accelerating, but data did come in hotter than they thought. And as well, Apple's iPhone shipments in China rebounded with a surge in March, according to a China-based research firm. This comes after Apple and third-party sellers ramped up discounting efforts. Some iPhone 15 models were discounted as much as 10%. And the U.S. has made another move in its computer chip war with China. The Commerce Department has revoked licenses to sell chips used for laptops and handsets to sanction the Chinese tech giant Huawei. Sources are saying that the affected companies include Intel and Qualcomm, and the Commerce Department confirmed the revoked licenses but did not name companies. The move comes after the release of Huawei's first AI-enabled laptop, powered by a new processor made by none other than Intel. So for more on this topic, I spoke to Robert Atkinson. He's the president of Information and Technology and Innovation Foundation. Take a listen. So Robert, always great to speak to you. And today we're talking about Huawei and what the U.S. is doing, revoking licenses to export chips from Intel and Qualcomm, according to people familiar with the situation. I mean, what do you think of this move? Is it going to have any material impact on Huawei?
Yeah, have a little short-term dent on them. It's not going to make them go out of business. It won't have a moderate-term effect on them. They'll continue to go along as they do, making phones and telecom equipment and selling it all around the world, except in the U.S. and a few other countries. What this will do is this will end up hurting U.S. companies, technology companies, and U.S. jobs. We're handing the Chinese a gift. The administration, the Biden administration, is handing the Chinese a gift with this decision, because Qualcomm's going to be selling fewer chips. That means a lot less revenue, or maybe not a lot, but certainly less revenue for Qualcomm, less revenue for Intel. It's weird because at the same time, Congress is saying we want more fabs, in other words, chip factories in the U.S. with the CHIPS Act, and Intel has just gotten support to build a big set of fabs. We're also now telling them, oh, by the way, don't sell chips. So I think this isn't going to do anything to Huawei, but it will cut our own nose off to spite our face. We're going to have fewer tech exports because of this, and it's going to hurt our companies.
What do you make of the argument that this is to bolster U.S. national security, protect American ingenuity, and diminish Communist China's technology advance?
It's not going to do it's almost going to do nothing to stop China's technology advance. Look, the administration has myopically focused on everything as related to national security and military, and they sort of have they have it's a one-trick pony, essentially. It's like all we can do is export controls, export controls, export controls. There's a vast array of other tools this administration is not using to limit China's technology advance. And what you want to do is you want to use the tools that hurt them and don't hurt us. This is a tool that hurts us more than it hurts them. And let's be honest, Huawei is a phone maker and they're a telecom equipment maker. The administration uses this concern about the security on the telecom equipment. This has nothing to do with that. If we don't want Huawei equipment in our national telecom infrastructure, we should ban them, which we did. Problem solved. But the idea that we can put Huawei out of business, which is what the Trump administration tried to do, what the Biden administration tried to do, you cannot put Huawei out of business. It's impossible. So they shouldn't be telling us this is a national security issue, because it's not. If we don't like their cybersecurity and worrying about hacking and just ban them from our telecom equipment, which is what we've done.
So are we talking about these chips specifically, or are we talking about extremely advanced chips not being exported to China? So for example, extremely cutting edge NVIDIA chips, should we sell those to China as well?
Well, that's a different question, to be fair, because that's not what this decision yesterday by the Commerce Department was all about. This was really about not the most cutting edge chips. You don't use the most cutting edge chips in telecommunications equipment. You just don't. So when you get into the most cutting edge, for example, NVIDIA and the like, it becomes a little bit more complicated, because some of those chips can be used for AI and large language models and the like, which are what are called dual use technologies. But even there, we have to be careful, because what China can do in a lot of these cases, they can do workarounds, they can put chips together to get the same kind of processing, but it just costs them more money. And what we end up doing is losing sales. So it's not an unalloyed good. Oh, we'll cut them off. Isn't this great? There's always a cost to us, and we just have to be cognizant of what that cost is and not just pull this trigger every single time we feel like it. Oh yeah, we're going to ban them. We're going to ban them. We're going to ban them. Well, we're going to cut our sales and cut our exports and cut the kind of R&D U.S. companies do.
Well, all right. Very well spoken here, Robert. Thank you very much for your insight today.
Hey, thank you so much. Take care.
Meanwhile, Elon Musk could be launching its robo-taxis in China. Sources told this to the state-backed China Daily newspaper. They said that during Musk's recent visit, he proposed testing Tesla's advanced driver assistance package in China by deploying it in robo-taxis. According to the article, Chinese officials told Elon Musk it welcomes Tesla's tests, but before Tesla can roll out its full self-driving functions, it still needs approval to collect data that the car needs for the driving assist features. No comment from any of the involved parties to confirm the report, though. And as China's population ages, millions are realizing they are unable to afford retirement. Monthly urban pensions range from roughly $415 to about $830 in Beijing and Shanghai. With the basic rural pension, if retirees relied solely on that, it will be less than the World Bank's poverty threshold. This is why many are forced to continue working. Statistics from 2022 showed about 13% of the labor force was older than 60, and that was up from years before. And this is on top of the one-child rule, disrupting the tradition of children taking care of their elders, which is compounding with the high youth unemployment problem in China. Disneyland Forward is moving forward. The city of Anaheim approved a plan to transform the theme parks, and the proposal does not expand the park's physical footprint. Instead, it's going to allow Disney to redevelop a massive lot with new rides and entertainment. Disney will invest at least $1.9 billion to the project over the next decade. And the Internal Revenue Service says the clock is ticking to claim the more than $1 billion in tax refunds from 2020. May 17th is the deadline for people who didn't file their 2020 tax return to become eligible for a refund. The IRS says there's no penalty for failure to file if you were supposed to get a refund that year. However, for you to actually get the refund, you have to file the return within 3 years of the due date. Traditionally, the filing deadline to claim old refunds are around April 15th, but in 2020, the filing deadline was extended to May 17th due to COVID. And that's all the stories we have for you today. Thank you very much for watching. And if you have any feedback for us, please feel free to let us know. You can email us at business@ntd.com or leave a comment online. I do read them for every episode. And as I always say before we go, business matters. See you tomorrow.